So Ronak, Sunteck Realty is a Mumbai-based developer, and it's the second largest in Mumbai.
Correct.
95% of your businesses is based in Mumbai.
Yes.
Why Mumbai?
So if you see, Chrys, Mumbai is a very resilient market relative to other cities such as Bangalore and New Delhi. I think similar to Manhattan in New York, it's one of the last markets to be affected when there is some sort of a downturn. I think when there is a bull run, it's one of the first few markets to outperform the others. We see similar trends in the Indian real estate for Mumbai. So from that perspective, we like our core focus to be in the Mumbai metropolitan region. I think the second interesting aspect about the Mumbai real estate is that it allows you to cater to all income segments. So you can have products that range from as low as $50 to as high as close to about $200,000. So I think it allows you to cater to the entire income segment which is prevalent today in Mumbai. The third, I think, which is a recent development, is that the Real Estate Regulatory Authority sort of came into play, and I think the Maharashtra RERA is one of the most efficient and practical authorities. So it's eased a lot of business for us as well, and accountability. So I think it's led to organized players like us sort of emerging in this whole consolidation, and I think it's a very interesting time for us going forward as well.
Mm-hmm. Can you explain, where your strategy of Sunteck, where you see a lot of opportunities, and currently there are many coming up, and can you please elaborate your strategy in capturing that opportunity?
Yeah, sure. So I think in the last few years, if you see, there have been certain macroeconomic reforms that are happening. Of course, I touched upon the Real Estate Regulatory Authority. There was demonetization to tackle, non-kosher monies, and then there was the GST implication as, tax reforms. I think all these has led to a lot of consolidation, a lot of the unorganized and opportunistic smaller developers.
Currently like 45,000 unorganized and organized.
Absolutely. So I think a lot of consolidation is happening. You're seeing a lot of larger players taking advantage of the situation. For us, given our financial strength, I think this is an inflection point for us. Going forward, I think we will opportunistically expand our portfolio. We see a lot of opportunity in the aspirational luxury, which is the affordable segment.
What will be the price range of aspirational?
So I think currently we have apartments ranging from $3,500 to $4,500. I think given plus minus 10%, but we would like to be in that category because that segment is huge. We're also seeing a lot of traction in the middle income group. I think the middle income group is becoming more and more aspirational. It's increasing with time, and they are the guys who are driving demand for real estate. So we are seeing a lot of traction in that segment under our city brand as well.
Mm-hmm. And it does make it for you the sense to having a EBITDA margin that you're making on the luxury segment side, roughly 60%, and then you're moving to a lower EBITDA margin. So that will kind of dilute your overall EBITDA margin.
Not necessarily, because one is of course the EBITDA margin. Second is to be able to be prevalent across all income segments. So from a strategy perspective, we want to be there in every segment. I think for us, more than EBITDA margins, we are very focused on efficient ROEs. So today, if you see, our adjusted ROEs are in the high teens, close to 13-14%. The plan is to double the company every 2.5, 3 years. So I think long term, we are looking to be close to 20% in terms of ROE levels. So we are very, very focused on that at a portfolio level.
Mm-hmm. And where you see the challenges going forward in the real estate sector, there's also competition coming in. How easy is to a new developer to come in and capture that market, which is currently consolidating?
I think, especially I'll talk in context of Mumbai, it's a very, very capital intensive market. So compared to the others in Mumbai, I think 50 to 60% of your costs are related to land. So somebody who comes in, one will need to have the financial ability to put in that much equity. Second, given the consolidation and the ongoing stress on the financial institution side, I think banks are also very wary of who they want to lend to. So I foresee a challenge for new entrants to be able to get credit facilities. And I think third, from a customer perspective, today is a buyer's market. I think they want to go in with a few organized developers who have the financial strength to see through the project, irrespective of the sales. I think today there are only a handful of credible guys who can command that sort of perception from the developers, from the customers. So I think for new entrants, it will be a big challenge in the current markets.
Because one of the best in terms of balance sheet, on the listed space, you have a debt to equity ratio of 0.17 times, and you have a borrowing cost is much less than other players as well, so it gives you a competitive advantage.
Absolutely.
Over the others.
If you see historically also, I think we did our maximum acquisition in the Lehman crisis days. So while Lehman crisis was something that happened in the US, and we felt the ripple effect because FDI money had just started flowing into India, we are in a similar situation. I think it is during these times where we see value for money. For us, we are seeing opportunities in three buckets. There are a lot of distressed developers who are looking to monetize their assets. So we are seeing attractive valuations. We're seeing a lot of corporates, landowners looking to monetize their land bank. So we have become the preferred choice. That has also been a very, very large focus historically for us. So we believe in putting in minimal capital, so our risk is low. We believe we bring a lot of value on the table in terms of our brand, financial strength, and execution track record. So it's an attractive proposition for anybody looking for a developer to step in. And the third, which is a function of the crisis going on in terms of financial institution, I think they want us to step into the shoes of their existing borrowers. They're willing to take haircuts. At the same time, they are also willing to have us on board in terms of the development management model, which is a fee-based model where we have no capital outlay, but we are able to earn a certain percentage of the revenue as the project progresses.
Okay, thank you very much.
Thank you so much.